I'm Phil Rowley of the Hurdle Group. We have designed PULPS, an internet-based loan pricing model with highly sophisticated analytics, yet easy to use. This DVD has been created to assist you in using the model. The model is located in the internet on our website, hurdlegroup.com. Once you arrive at the website, you will find a menu of options available to you on the left side of the main page. To assist you, most of the navigation through the model is by either point and click or filling in required information. Once you are at this page, merely click on User Login to access the model. This will take you to the login page, which requires your assigned username and password. Once you have input that information, click on Login to go directly to the first page of the model. If you have difficulty with the login, contact us at 847-352-4770 and we will be glad to assist you with this login, or if you have any other questions as you go through the model, this same number can be used to get assistance. Now that you are in the model, you can enter the borrower name, the lender, and aggregate borrowings of the customer of the loan being priced. None of this information is required to get pricing results from the model. It does become part of the record for when you print the results. Usually you will have the name of the borrower and lender, but may or may not have an aggregate borrowing amount. Once you have completed the input on this page, click on Update at the right side of the page. This completes the first stage of the loan pricing process. Next, to begin entering the characteristics of the loan being priced, click on Loans shown in the drop-down box at the left-hand side of the page. You are now in the guts of the loan pricing model. Note that at the upper right-hand portion of the page there are two tabs. One tab labeled 1 and the other tab New. In PULPS you have the ability to price up to 3 loans for the same customer to get a consolidated result, or if you want to price the same loan with up to 3 different pricing characteristics, you can do that and view the loans side by side on a summary page. For this session we will be pricing just one loan, hence the tab opened shows a 1. The first input is the dollar amount of the loan. This is the beginning principal amount of the loan, or if the loan is a line of credit, the expected annual average balance of that line. In this example, we will make a loan with a beginning balance of $1 million. Next is a box to click on if the loan is a credit line. If it is not a credit line, this box remains unchecked, as we have done in this example. If, however, the loan were to be a credit line, we would then be required to put the expected months of usage in the box to the right of the checked credit line box. You can then check a box to indicate if the loan floats with an index such as prime rate or LIBOR. If the loan reprices on the date a particular market rate changes, this box will be checked. A key point to remember here is that if the loan reprices to an index at some time in the future to the rate of the index as indicated in the terms of the loan and not when the index changes, it is an adjustable rate loan. An adjustable rate loan is addressed later in the pricing of this loan. A floating rate loan is not an adjustable rate loan and therefore cannot be priced as both an adjustable and floating. In this case, the loan is fixed rate and therefore the box is not checked. Next is a box to check if the loan is a renewal. If it is not a renewal, the box remains unchecked as we have done in this example. The purpose of this box is to assign a slightly lower origination cost than if the loan is new to the bank. We now input the type of loan payoff period. By clicking on the right side of the input box, a drop-down menu allows you to pick fully amortized, bullet, or amortized with a call date. A bullet loan is a loan that has no principal payment until the maturity of the loan, while fully amortizing and amortizing with a call date pay off gradually over the life of the loan. The loan payoff period is used to calculate the duration of the loan. For this example, we have picked amortization with a call date. Now we select the loan type from the drop-down menu. By clicking on the down arrow on the right of the box, there's a selection of 11 different types of loans. This is a generic list and may not be the exact name of the type of loan you are making because different institutions have different names for different types of loans. That being the case, pick the definition that best describes the type of loan you're pricing. In this case, we have selected a land loan. Next is the amortization period of the loan, or the maturity. In this case, the loan has an amortization period of 210 months and is callable in 120 months. Therefore, 210 is input into this box. The number of months to the call is then input as 120. If you are pricing a loan that you truly believe it will prepay prior to maturity, and it does not have a contractual call date, you would input the best estimate of when you think the loan will prepay. Next, if the loan is adjustable, we would click the box next to the line beginning "Loan is adjustable." We would then put the number of months to the first adjustment period in the box to the right of this box. As was stated earlier, the loan being priced is fixed rate and is not adjustable. Next, you can designate the loan as being tax exempt or not. If the loan is not tax exempt, this box remains blank as we have done in this example. We now input the initial loan rate. In this case, the rate is 8%. If the loan is a floating rate, we would input the initial rate even though it will change when interest rates change. An example would be a loan tied to prime. If prime is 5% and the loan being priced is going at prime plus 1%, the amount input in this box would be 6%. If a loan fee is to be received, we now input the dollar amount of the loan fee in the box labeled Fees to be Received. On this loan, we will assume a loan fee of 0.5% and will input $5,000. We are now at the final step of the loan input page, and that is to determine the risk rating of the loan. A drop-down menu is provided which gives you an opportunity to pick a level from 1 to 10. Again, this is a generic classification. You will need to select one that most likely meets your bank's level of risk measurement. If, as an example, you have a 1 to 8 scale and you risk rate a loan at 4, it would be classified as a 5 in a 1 to 10 risk rating scale. For purposes of this session, we will give the loan a risk rating of 4. We have now completed the input on this loan. It is important to remember that before you go to the results that you click on Update in the lower right hand corner of this page. Once that has been clicked, you are ready to add another loan, add deposits to the pricing, or view and print results. If there are incremental deposits received with this loan being priced, we would then click on Deposits at the left portion of this page, and it would take us to a page for that input. The deposits page looks like this. It is extremely important that the user understand that this is usually a subjective portion of any loan pricing. Unless there is a requirement for compensating balances, anything input in the deposit section of the model is a guess at best. We therefore recommend that if the user utilizes this page, that the loan be viewed with and then without the deposits to see the profitability. If the loan passes without the deposits, the loan meets the loan profitability goals. If the deposits are required to make the loan profitability goals, it is imperative that the relationship be monitored throughout the time the loan is on the books to make sure the deposits anticipated are truly kept by the customer. In this case, there are no deposits anticipated with this relationship. Therefore, there is no information input on this page. If there had been any deposits, the boxes would be filled in with the amount of deposits of each classification. Of note is that the balances to be input are balances above and beyond what is required for the servicing of the account. We now go to the results page. On the results page, the final output of the loan pricing can be viewed and printed. As you can see, the detail contains the loan yield, cost of funding, risk, origination and servicing costs, the loan fee, and return on assets and return on equity of this loan. Based on the return on asset objective set in the administrative section of the model, the loan will either show pass or fail. In the example we have just input, the model shows the loan to pass the 1.50% return on asset goal. Also on this page, the duration of the loan is shown as being 99 months. This is calculated by taking the loan with a 210-month maturity and a 120-month call. Below that is the yield curve, which is automatically updated by the hurdle group every Monday. It is the Federal Home Loan Bank of Seattle curve at that time. By clicking on the small printer at the top of the page, printed documentation is created to accompany the loan documents. This will be your permanent copy of this unique loan pricing. For confidentiality reasons, there is no information retained in the model once you log off this session. This completes the pricing of this loan. You can, however, return to the input page and change and review any of the variables input into the loan. Remember that each time you have an update to any of the information and wish to see the results, click on the Update button at the bottom right-hand portion of the page being updated. Additional information available for your review and update are the rates and tables, which can be accessed by clicking on the Tables tab on the menu at the left of the screen. The Rates page shows the rates you can change to reflect rates outstanding in your institution for savings, money markets, and taxes, as well as the return on asset and return on equity hurdles. In addition, a hierarchy of approval can be established. This hierarchy sets levels where the loan pricing may require manager or a higher level of approval. If the level of return on assets falls below either of these levels, a message will be included on the output page stating the need for additional pricing approval. As stated, any of these rates on this page can be set by the user. It is recommended that your institution establish an approved level for each of these rates and only be changed by an administrator of your organization. Now click on the Table tab at the top of the page. You can now view the numerical data behind the current yield curve in the model. You can also see the origination and servicing costs for each type of loan. Although you can view them, this information is set by the model and is updated as needed by the hurdle group. This completes training on PULPS, our Internet Commercial Loan Pricing Model. I think you will agree it is an easy-to-use model. Feel free to experiment with different types of loans and to use the multiple loan pricing feature. Because of the ease of use, this process of experimentation is both quick and can be quite enlightening as to what seemingly small changes in loan pricing structure can have on the profitability of a loan. What you don't see are the analytics behind the scenes providing you with a way to ensure the pricing of your loans is profitable and consistent for all users. That is the value of PULPS. Thank you for selecting PULPS. We at the Hurdle Group look forward to working with you in future years.